Hey, welcome back. Today we're covering a topic I get asked about a lot: how to get started with online stock trading. If you've been curious about investing in the stock market but felt like you didn't know where to begin, this video is for you. We're going to walk through everything from choosing a brokerage account, to picking stocks, to placing your very first trade. We'll also cover costs, taxes, and some things to watch out for as you get started. This is a beginner's guide, so we're keeping things clear and straightforward. Let's get into it. The very first thing you need to do before you can buy a single stock is open a brokerage account. Think of a brokerage as the platform that connects you to the stock market. Without one, you can't trade. There are a lot of options out there, so take your time before committing to one. As you research, there are a few key things to look at. First, trading fees. Many brokerages now offer commission-free trading, meaning you don't pay a fee every time you buy or sell a stock. That's become the standard for most major platforms, but it's still worth confirming. Second, look at the platform itself. Is the app or website easy to use? Is it intuitive enough that you can navigate it without getting lost? As a beginner, you want a platform that doesn't make things more complicated than they need to be. Third, check whether the brokerage offers any educational resources or research tools. Some platforms provide stock analysis, financial data, and learning materials that can be genuinely useful when you're just starting out. In terms of specific options, established firms like Fidelity, Vanguard, and Charles Schwab have been around for decades, have strong reputations, and offer low fees with solid research tools. Then, there are newer platforms like Robinhood, Webull, and SoFi that are designed specifically around easy-to-use mobile apps and small trades. Neither style is universally better. It depends on what you're looking for and how you prefer to interact with your investments. Once your brokerage account is open, the next step is figuring out what to actually buy. And this is where a lot of beginners feel uncertain. So let's address it honestly. If you're brand new to investing, individual stocks may not be the best place to start. Picking individual companies requires research, analysis, and a tolerance for the fact that any single company can have a bad year. A safer and often smarter starting point for beginners is exchange-traded funds, or ETFs. An ETF is essentially a bundle of stocks packaged together into a single investment. Instead of buying one company, you're buying a small piece of many companies at once. ETFs that track major indices, like the S&P 500, the Dow Jones, or the NASDAQ, give your portfolio broad exposure to the overall U.S. stock market. When the market goes up, your investment goes up. And because you're spread across hundreds of companies rather than just one, you're not as vulnerable to any single company having a bad quarter. Many investors also diversify beyond stocks entirely by adding bonds to their portfolio. Bonds tend to be more stable than stocks and can help cushion the impact of market downturns. A portfolio that includes both stocks and bonds is generally considered more balanced than one that holds only stocks. As you grow more comfortable and knowledgeable, you can start looking at individual stocks. When you do, use financial analysis tools and ratios to compare companies against their competitors. Not just how a company looks in isolation, but how it performs relative to others in its industry. Now let's talk about the mechanics of actually buying and selling, specifically the types of orders you can place. The two most fundamental order types are market orders and limit orders. A market order executes immediately at whatever the current price is. It's simple and fast. You decide you want to buy a stock, you place a market order, and it's done. The trade happens right away at the best available price in that moment. A limit order gives you more control. Instead of accepting whatever the current price is, you set a specific price at which you're willing to buy or sell. Your order won't execute until the stock hits that price. If you're buying, your limit order will only go through if the price drops to your target. If you're selling, it only executes when the price reaches the level you set. This approach takes more patience but can help you get a better deal. There's also something called a trailing stop-loss order, which is worth knowing about once you own a stock. This type of order lets you hold on to a stock as long as its price keeps rising, but automatically sells it if the price drops below a certain threshold. It's a way of protecting your gains without having to monitor the market constantly. No single order type is better than the others in every situation. The more you understand about each one, the better equipped you'll be to use the right tool at the right time. Let's talk about costs, because expenses can quietly chip away at your returns if you're not paying attention. As mentioned, most major brokerages have moved to commission-free trading for individual stocks. That's great news for beginners. But once you start investing in ETFs, mutual funds, or other managed investment products, you need to understand something called the expense ratio. An expense ratio is an annual fee charged by the fund, expressed as a percentage of your investment. For example, an ETF with an expense ratio of 0.1% means you pay 10 cents per year for every $100 you have invested. That sounds tiny, and for low-cost index funds it usually is. But some actively managed funds charge much higher expense ratios, which can significantly impact your long-term returns. Always check the expense ratio before investing in any fund. Another cost to think about is risk, and specifically, your own risk tolerance. If your portfolio suddenly lost half its value, what would you do? Would you buy more, hold steady, or sell? If your instinct is to buy more after a crash, you likely have an aggressive risk tolerance and can handle more volatility. If your instinct is to sell, you have a more conservative tolerance and should look for relatively stable investments. But risk tolerance isn't just about personality, it's also about your financial situation. Even if you're comfortable with risk emotionally, you shouldn't invest money you can't afford to lose. If you don't have an emergency fund, for example, you shouldn't be putting your limited savings into volatile stocks. Always invest from a position of stability, not desperation. Taxes are a part of investing that beginners often overlook, and they can have a real impact on your returns, so it's worth understanding the basics. When you sell a stock for a profit, you owe what's called capital gains tax on that profit. How much you pay depends on how long you held the stock before selling. If you sell a stock within a year of buying it, your profit is taxed as a short-term capital gain, which is taxed at the same rate as ordinary income. That can be a significant amount depending on your tax bracket. If you hold a stock for more than a year before selling, your profit is taxed as a long-term capital gain, which typically has a lower tax rate. This structure is intentional. It's designed to encourage long-term investing rather than frequent short-term trading. You can also sell stocks at a loss to reduce your tax bill. Those losses can offset gains elsewhere in your portfolio. But be aware of the wash sale rule. If you sell a stock at a loss and then buy the same stock within 30 days, the IRS disallows the tax benefit of that loss. The loss gets deferred until you eventually sell the stock again. If minimizing taxes is a priority for you, consider using a retirement account like a Roth IRA or a 401k for your investments. In these accounts, your money grows tax-advantaged, meaning you either pay taxes now and withdraw tax-free later, or defer taxes until retirement. For long-term investors, this can make a substantial difference. When you're ready to place your first actual trade, here's how the process works. Start by funding your brokerage account. You'll link it to your bank account and transfer money in. Depending on the brokerage, it may take a few days for the funds to settle and become available for trading, though some platforms give you immediate access while the transfer processes. Once your funds are available, log into your account, search for the stock or ETF you want to buy, select your order type, enter the amount, and place the order. If you're using a market order, it should execute almost immediately. If you're using a limit order, it will sit pending until the stock hits your target price. After placing the order, keep an eye on it to make sure it executes as expected. As you get more comfortable, the process becomes second nature very quickly. As you build experience and confidence, you may start hearing about more advanced strategies. It's worth knowing what they are, even if you're not ready to use them yet. Trading options is one example. Options give you the right to buy or sell a stock at a specific price within a certain time frame. They can amplify both gains and losses, which makes them significantly riskier than straightforward stock trading. Not something to explore until you have a solid foundation. Trading on margin is another. This involves borrowing money from your brokerage to invest. It can multiply your gains, but it can also multiply your losses and land you in debt quickly. Margin trading is one of the fastest ways for inexperienced investors to get into serious financial trouble. Avoid it until you're highly confident in your abilities. Short selling is related to margin trading. When you short a stock, you're essentially betting that it will go down in price. You sell it first, then buy it back later at a lower price to make a profit. But if the price goes up instead, you still have to buy it back at a loss. Short selling is complex and carries significant risk. The clear guidance here: As a beginner, stick to simple buy and hold strategies. Master the basics before adding complexity. Finally, it's worth knowing that buying individual stocks or ETFs through a brokerage isn't the only way to invest. Mutual funds are similar to ETFs in that they hold a diversified mix of investments, but they don't trade throughout the day the way ETFs do. They're priced once per day after the market closes. They can be a good option for investors who want diversification without actively managing their portfolio. Robo-advisors are another alternative worth considering, especially for beginners. These are app-based platforms that use algorithms to automatically build and manage an investment portfolio for you based on your goals and risk tolerance. You answer a few questions, deposit money, and the platform handles the rest. They tend to have low fees compared to traditional financial advisors and are designed to be easy to understand. For someone who wants to invest without spending a lot of time learning the details, a robo-advisor can be a genuinely solid option. Let's bring everything together. To get started with online stock trading, open a brokerage account with a reputable platform that fits your needs and has low fees. If you're a beginner, start with ETFs that track broad market indices rather than picking individual stocks. Learn the difference between market orders and limit orders so you can control how and when your trades execute. Understand the costs involved, especially expense ratios for funds. Know your risk tolerance and only invest money you can afford to leave in the market. Pay attention to the tax implications of your trades and consider using a tax-advantaged retirement account for long-term investing. When you're ready, place your first trade, start simple, and build your knowledge from there. And as you grow more confident, you can explore more advanced strategies. But take your time getting there. Investing is a skill. The more you learn, the better your decisions become. And the earlier you start, even with small amounts, the more time your money has to grow. If this video was helpful, please give it a like and subscribe for more content on building your financial knowledge from the ground up. Drop any questions in the comments. I'd love to help. Thanks for watching. I'll see you in the next one.